we will now move on to the third lecture of funding demystified, that is valuation of a startup. So when it comes to fundraising, valuation is regarded as one of the most important factors for both an investor and a startup. I would like to invite Mr. Kailash to provide knowledge on the importance, process, assumptions, and a better understanding of valuation. A brief introduction about Mr. Kailash. So Mr. Kailash is an AVP seed stage at Chiratae Ventures, where he focuses on seed stage investment opportunities in early stage tech companies. Chiratae, formerly IDG Ventures India, is a leading technology venture capital fund in India. The fund is part of IDG Ventures, a global network of technology venture funds with over $6 billion under management with over 220 investee companies and 10 offices across Asia and North America. In India, IDG Ventures has invested in companies such as Flipkart, Myntra, Yatra, Newgen, Brainbees, FirstCry.com, VServe, Manthan Software, Value, Acto Sirpa, Nestway, and Hyrie. Before joining Chiratae, Kailash was a part of the investment teams at Bharat Innovation Fund, an early-stage deep tech-focused venture capital fund, and Unitus Ventures, a seed-stage investor in the companies building technology solutions for the masses. Without a further ado, I would like to invite Kailash, and the session is over to you.
Just checking my mic. Is everyone able to hear me well? Are you able to hear me? Right?
Yes, yeah.
Yes. Okay. No, it's just one of those bad days when early morning I get up and I see that my internet is down. Thankfully, I could arrange a backup connection. But okay, as long as you guys can hear me, I think great. So thanks a lot. Thanks a lot to the organizing team for a great introduction and really privileged to be speaking to what I hear close to 500, 550 gathering 500, 550 people across entrepreneurs, probably founding team members, advisors to multiple startups, and probably investors as well, and startup enthusiasts. So really great to be addressing this gathering and sharing some learnings from what I've seen across my 3 stints in 3 venture capital firms so far, and do's and don'ts, and probably some of the learnings on the valuation side, right? So probably I'll quickly share my screen. Am I allowed to share my screen?
Yes.
Yes, 1 second. Let's say share your screen. Okay, is my screen visible?
Yes, it is visible.
Okay, great.
You can
Super.
open it in a full screen mode.
Full screen mode. I will do that. Yeah, it's here. Yeah, this better?
Yeah, perfect.
Great, super. So this would have been a much better experience for me, as well as I'm sure for the audience as well, if this was offline and in person. But unfortunately, we live in a world where we are unable to meet each other in person. But anyway, let's see how much of what's the best that we can do in a virtual gathering itself, right? So again, thanks to the organizing team at Athine for allowing me and giving me this opportunity to speak to all of you about some of my learnings on valuation of startups, and probably I'll probably share some of the don'ts more than do's about valuation, right, as we go by. Quickly, a quick introduction about Chiratae Ventures. So the organizing team has already done a great job, but we announced this yesterday. We went live yesterday with this announcement. We closed our Fund 4, our largest fund so far. And this makes us the largest VC in the country, largest homegrown VC in the country, right? So we truly are a Desi VC, as we call ourselves.
Kailash, sorry to interrupt. Can you hide the button that is there on the screen?
Yes. Okay.
Thank you.
Better? Okay, great. No, saying this, we are truly a Desi VC, a VC firm which is born in India and continues to believe that India is the place where the next set of disruptive technologies will come in. Really want the companies that we back to dominate the Indian market, disrupt the space in which they are targeting, and spread globally. Right, become the next unicorns, and unicorns not just by the definition of $1 billion valuation, but really become household names in terms of the industries that they target. Right, so this is the focus and vision with which this firm was born, and we continue to hold that vision very closely. We are a sector agnostic firm. We invest across sectors. We're a stage agnostic firm. We invest right from seed stage all the way up to Series C in our first checks. And of course, we back the companies that we invest in. We continue to support them through not just financial, but also multiple other ways of portfolio management initiatives, and help them hire, help them access markets that they haven't targeted or don't have easy reach into through our networks. Help them prepare for the next round of funding, help them in ways. I mean, basically, we are the sounding boards, right? Advisory set of people whom they reach out to whenever the going gets tough or whenever they need help with. So that's just something that we've always believed in. Right from a seed stage of $500,000 a seed check, we go on up to almost $7-8 million in our first check across the growth stages. Sometimes I think a few investments we have made have even crossed that number. But really, a truly sector agnostic firm. The most of our work we do is focus on early stage. So about early, I mean, seed, in fact, we're evaluating opportunities pre-seed stage as well, right? So pre-seed, pre-series A and series A, that's typically the early stage, or maybe early series B. That's typically our most of the focus goes in there, and evaluate opportunities very opportunistically at the growth stage as well, right? Some of the highlights: we have about 4 unicorns from our portfolio so far. Of the 100 deals that we have done, 100 investments that we have done, active portfolio is around 60 plus. Close 38 have been exits. Backed some really interesting, disruptive, and deep tech. So multiple patents which have come out of the technologies that our portfolio companies have built. 2 IPOs. We also have one IPO coming in later this year in form of Policy Bazaar. So that will make it 3. So it's broadly about us. I mean, I can go on for an hour talking about us, but probably we'll reserve this for the Q&A session. Happy to answer more about us, or talk more about us, or answer any questions about us as we go by, right? So maybe quickly jump into the crux of what I want to cover. You know the background. I mean, from the introduction, you know about valuation, and probably a lot of questions that most of you are. In fact, let me include myself also into the group, right? I mean, a lot of us have a lot of questions about valuation as we traverse through the journey with our portfolio companies, as well as the companies that we evaluate for potential investments. Something that I've learned or come to believe from pretty early on in my VC career is investments in general are a very, very subjective matter, right? Someone told me investments is like love. I mean, everyone does it differently. So it's as subjective as that. So the rules that apply to me as an investor might not apply to you as an investor or an entrepreneur. We all look at things very differently. That doesn't make me any more correct or you less correct or more wrong. So we all have to play our own game. So there are no rules in investments, by the way. There are only principles that you follow, and there are practices that you pick up, and things that work well for you. So from that standpoint, there is no right or wrong when it comes to investments, and that's one thing that is as an investor we always do, right? I mean, we might disagree with someone's investment approach, but we'll always respect them because we know that they have chosen something that works well for them, right? Same thing with valuation. We might value an opportunity in a completely different manner than maybe some other investors might, and that's perfectly fine, right? Like I said, there's no right or wrong here. But I want to start off with that prelude, and want to give you a sense of the financing ecosystem at an early stage, and probably give you a sense or impress upon you the fact that If valuation happens differently at different stages, expectations of an investor at different stages is different. As we go through the journey with our portfolio companies, our expectations as an investor itself mature and vary, right? And this is this is something that I have seen internally in the team. This is something I have seen among friends who work with other fellow venture capital firms. When you're investing in a seed, the thing that you look for is completely different than what you look for when you're backing them at a Series A or Series B stage, or probably modeling their exit as they go by and provide you an exit whenever that happens, either an M&A, go public, or get acquired or whatever it's, right? So I mean, it's more so true when you're looking at different players occupying their seats in different parts of or different stages of the evolution of a company. Like you're talking about a pre-seed where the company is just developing what they're developing, right? Could be a product, could be a platform. You're talking about sources of capital like research grants, competition prize money, which are usually not dilutive in nature, but if probably also incubation support. I mean, one of the things that DST, Government of India, has done is support a bunch of incubators who have become the sort of test beds as well as the source of a lot of disruptive early stage tech that we are seeing in our ecosystem. And some of the incubators that I personally know, and I've had a chance to look at multiple of incubators in the last few years, is some of them take small token equity, and they value the company in a completely different way than maybe we do at a VC stage, right? There it's more about this amount of support that's being given, right? Sometimes there's a single rule saying that we'll invest maybe 100K and we'll take up 10%. It's maybe as simple as that. So there's no really a valuation or a science of valuation there. It's more about agreed sort of an agreement that you have for the incubator providing the startup enough time and effort and the network access, etc. Right? So that's the kind of valuation that happens there. As you move towards seed, you have multiple other entities like your friends and family. You have angel investors, some HNIs, some ex entrepreneurs, people who would have run a company successfully, got an exit, have proceeds from the previous exits, and want to support the rest of the ecosystem through initial capital push as well as access to their network, right? They value companies in a different way. Sometimes they don't just come in as an equity investor, they also provide a convertible. So if probably an angel investor is putting in 100 rupees, let's take some token money, right? So 100 rupees, and they say we'll have a convertible invested, and we will take a 20% discount to the next round. So whenever there's a next round or a valued round, we will get a discount to the valuation, right? The way it works is, suppose you're putting 100 rupees, and then the move forward, or you fast forward, the company is raising a larger VC round where the company is valued at say 1,000 rupees of pre-money valuation, right? This some numbers. They would get say 20% discount, which means that their effective pre-money valuation will be 800 rupees, and 100 would then convert at 800 rupees pre-money valuation than 1,000 rupees, right? If there was no discount, they would get say 100 out of the post money would be 1,100. So 100 of 1,100 is 9% of stake. Now, since they have a discount, they get 100 out of 900, which is the post money post discount, which will be close to what, 11%, right? So you get that additional 2% because you have come in early, because you have taken far more risk at a time that the company could not raise a venture capital round, right? So there the valuation works in a different way. In fact, most of the angel investors want the company to take the money and get running. So don't even spend time valuing the company. So straightforward convertible is what works well for them because speed is of essence there, right? So fast forward, coming to venture capital or an early stage venture capital stage, you're talking about C-stage investors, micro VCs as some of them call themselves, some HNIs, UHNIs who even come at that stage and say, look, take $500,000 from us, and we will join a syndicate of investors who come to say invest in a company, probably $1.5-2 million seed capital, right? So that's a typical practice there. There also there have been instances where convertible rounds happen, but valued rounds are a little more often than as compared to earlier seed stage, right? You're talking about pre-series A or maybe early series A, where there are multiple approaches to valuing the company, and I'll talk about some of the approaches as we go by. Fast forward, the company does a commercial launch. It moves towards a break even. It's found its product market fit, as it's called, early revenues coming in, probably hit a break even at operational stage where you are now generating more money than you're consuming in terms of your costs. It's actually a great milestone. And when I talk to entrepreneurs, I wish they get the product market fit and break even as quickly as or more quickly than they anticipate, right? That's a great milestone to have. So what I'm saying is that once you hit the milestone, the kind of investors you would then take money from are completely different, and their expectation is completely different as well, right? The risk that they would take is much lesser because they now know that they have now they're now looking at a company which has a product in the market, and the company at least won't go down. It'll stay put in terms of its revenue. Assuming that everything works well at the founding team level, at least, I mean, people don't leave the team, at least, right? At least the team stays put. The product has reached a stage where the risk is significantly lesser than earlier stages. So the expectation in terms of returns is also lesser because you're carrying lesser risk, right? You talk about, then you probably go and talk to some early stage private equity firms or growth stage venture capital firms, and there are quite a few active ones in India itself. Maybe you talk to strategic investors, right? There are a lot of companies which are in the strategic, in the same domain as our established incumbents in the same domain or industry, who have set their family offices, who might want to get exposure to a very new age tech in the industry that they are otherwise active in, right? So investors like that become very interested at this stage. And of course, you have the venture debt asset class also, thanks to some early players like Trifecta. I think this is one asset class that's is getting a lot of traction among the startup ecosystem, and I think it's a great initiative by some of those players. But what I'm saying is the risk expectation or the return expectation is lesser because the risk is lesser, right? So the valuation also will vary as you go from one stage to another. The amount of dilution expected in terms of the stakes that the investor expects is also lesser. Of course, it varies deal by deal or investment by investment. But what I'm saying is, it's on an average at the late stage, dilution is lesser than early stage in terms of the risk itself. If someone is putting probably $1 billion, then probably the dilution is of for different. That's a different discussion altogether. But typically, what happens is, on an average, the risk seen and the valuation expectation at the early stage is different than a later stage, right? So this is a sort of a background for you to understand the subjective, quote unquote, science that valuation is, right? Probably move on to this beast called a venture capital firm that some of you will be dealing with as you go and raise your VC rounds. To just give you a sense, right? A VC fund is actually a vehicle that is floated by two, or rather participated by two people, floated by a set of founding team members of the VC fund called general partners. These are investment professionals who come together, who invest their capital and say, we are floating a VC fund. Usually, it's typically, if the VC fund is of 100 rupees, like again, a token of 100 rupees of size, typically GPs bring in close to 2 to 3% of the capital, and they invite limited partners, and these are larger investors, institutional investors, or even retail, in fact, who would want to participate in their adventure of running a VC fund, right? And then usually there's an investment thesis behind a VC fund. They would want to invest in certain kind of startups. For example, we invest in tech startups, right? Disruptive tech, deep tech. This is what excites us. So maybe some of the VC funds would want to invest in consumer tech. Some of them would want to go deeper and say, we are a deep tech only firm, and I've worked in a firm like that. Or maybe want to build an impact fund where you're saying technology delivering impact to underserved masses or underserved segment of the larger Indian mass. So there's usually a accompanying thesis that goes with in terms of proposal to the limited partners, the LPs as we call them. LPs commit to the VC fund, and it's the investment contribution that comes in. And a VC fund is then, I mean, what's called this something called as first closing, where there's a certain amount of capital that comes in, and then they do the GPs do a first close and start investing in companies that they have identified as investment opportunities, and then they continue to raise it till a final milestone called a final close. For example, we hit our final close last week, and we announced it yesterday. So we now have our fourth fund, out of which we'll continue to invest. Similarly, a VC fund will do a final close and continue to invest in their investee companies. I mean, once you invest, there's usually a holding period of close to 5 to 6 years, and during this time, the company grows, the portfolio company grows and raises further follow on, gets to a stage where there's a large investor who comes in and invests, or maybe there's an acquisition, or basically there's a liquidation event which gives an exit to the VC fund itself, and that's distributed back as proceeds to the limited partners. There's something called as carry. If you carry that goes to the GPs. In fact, if you hit a particular hurdle rate, usually a typical minimum rate that you are promised your LPs as a return, or what we call IRR. Once you cross that, the rest of the additional upside, there's a distribution between limited partners and the GPs, usually in a 80-20 ratio. So that's the carry that GPs get. That's a reward to them for the performance they have shown in terms of identifying the right investment opportunities, taking the right calculated risk, and working with the portfolio companies to get the exits that they had thought of, modeled, and probably even promised LPs. Right. So that's the real reward that comes at the end of the VC fund's operation, and this continues. The firm which floats the first VC fund will continue to float many more VC funds, and the journey goes on. Right. The reason I brought this up is when you're talking to VC firms, right? So the structure and some of the restrictions that they have, or rather the constraints that they operate in, is something that you would want to keep in mind, because that drives a lot of valuation discussion that you would have with the investment team at the VC firm, right? Some of them are like return expectations. The return expectations from limited partners here is that they will deliver a supernormal return which they can't otherwise access in a public market, right? So you're taking higher risks, so obviously the return expectations also higher, that you will deliver like 20% IRR, 25% IRR on a year-to-year basis. So that's the general expectation. Fund timelines, this is not a VC fund typically operate with a what's called 8 + 2 years, or 7 + 2, some of them, where you have the right from the first close, you have the investment period starting, and typically you have like a first 5 years where you will keep investing whatever the capital is, and the next 2 years you look to get exits and return back the capital. You probably can extend it to +1+1. I mean, it's 7 + 2, 9, or maybe 8 + 2 if your LPs are generally flexible with their timelines. But the point here is that a VC fund has to get an exit from its investments, right? Which means it can't go on forever. Right? There are some evergreen funds which have like super patient capital. They invest and they wait for like 25 years to get an exit. That's not the timeline that a VC fund is looking at. So there is always an expectation to exit earlier than maybe some of the entrepreneurs would like it to have, but it comes with which is why some of the business models that technology allows is not a great fit for a VC investment, right? That's something that needs to be kept in mind. If a VC firm says this is not a space that we are looking at, even though it might be large market, it means that the VC fund is not confident that it will get an exit within that timeline, right? Which is okay, right? I mean, it doesn't make your business any less attractive. It just means it's not a great fit for them. Investment philosophy and mandate, I told you, some of them, most of the VC funds come with a investment philosophy, consumer internet or deep tech or impact, etc. Right? So the focus is on that particular thing. So for them, if you meet the mandate and there's a great overlap with the mandate, generally they if they like the opportunity a lot, they will be flexible with the valuation, and maybe the negotiation will be a little more broader in terms of the range of valuation they will be willing to provide you. There's a restriction on amount invested. For example, some of the VC firms I've seen have a restriction that of the total VC fund value, you can't invest more than 15% in a single company, or I think 10 to 15%, depending on how you negotiate. That's a typical limitation. So you can't have concentrated bets or not super concentrated bets in your VC fund, right? And there's reported requirements. Most of the VC funds like us have a finance team which liaisons with the investment team to collect data, and there's always on a quarterly basis data is presented to the LPs. Right, this is a mandate that we have, and there's a deadline. Right, after every quarter, you have got to get the data out in the next a week or 10 days maximum. So there's a reporting requirement, and it means that the data needs to be collected. And on the entrepreneur side, there has to be a team which is providing the data on a sort of on a regular basis. And there might be other legal financial compliance. I've seen funds which have taken money from investors who have restrictions in terms of investing certain sectors, investing in entities which are based outside India because the capital can't leave India mainland. So other compliance issues that needs to be kept in mind, right? Just a quick time check. Yeah, I'll probably go deeper into the valuation itself, but I just only wanted to give you a sense that these are the things that impact valuation, and these are the things that you need to keep in mind as an entrepreneur before you go and get into a valuation discussion, right? These are things that drive your conversation with the VC firm. So let's getting into the valuation piece itself, right? Maybe one other point that keep in mind is probably slightly disagreeing with the introduction that was given to me is valuation is not the most important thing, or what is not one of the most important aspects. It is one of the points that need to be discussed and kept in mind when you're having conversation with investment team members of a VC fund. But there are a lot of things that go in before a valuation discussion can be arrived at, right? Few things that investment team, and even I do it when I'm speaking to potential portfolio companies or companies which we look to invest into, right? We look at how strong the investment, so the founding team is. Do they have relevant experience? Have they done something in the last 3 or 4 years that gives us the confidence that they're the best team to address a particular problem? Do they have complementary skills? Do they have the relevant network, etc.? So how strong the founding team is, and what gives us the confidence that this set of founders will be able to drive what they have promised in the next 5, 6, 7 years that we are with them. Addressable market, and this is very important because typically, I mean, this is across VC firms. We would like to look at opportunities, right? For example, us, we look at tech opportunities, startups which are developing technology, which looking at disrupting a massive industry, right? For example, we look at healthcare very, very closely, and healthcare is a classical example. Healthcare, in fact, is so important that it's probably the sector in which Chiratae has invested most of its capital, almost like $150–160 million have gone into health tech only. I'd say health tech actually include the biotech piece as well there, but it's one of the most important sort of sectors for us, and we continue to evaluate opportunities there. But the point I'm trying to make is this is an industry where tech can change the way care is delivered. It can change the way patients interact with doctors, with care providers, right? So it's a very, very large market which can be disrupted by technology. So we look at spaces like that, which is ripe for disruption using technology. So similarly, across VC firms, I think how large is a target addressable market and what are the growth drivers there becomes very, very important, and how concentrated or fragmented the market is. What are the alternatives, right? If not your technology, what else is a user using, and why will your technology bring about the disruption in terms of both the behavioral as well as the accessibility question here in terms of users being able to use what you're wanting to provide. Now, of course, price is also a consideration here. Are you as expensive or less expensive than what is already in the market, etc.? Right. So those considerations, differentiation, and some of the tech-led teams do this. We talk about what's a deep tech here, what's technology IP here, what's a competitive edge coming in from the way you are building products as compared to what else others are building, right? So that is additional questions for a lot of tech-led VC firms. unit economics, and I'll talk about unit economics in some of the other slides, but very, very important to understand, is the pricing right? Is your cost in control? What your pricing will you get to a stage where you can break even quickly? So questions around the entire unit economics. Have you thought through multiple non-obvious cost items like logistics, like repair and maintenance if you're developing a hardware solution, talking about maybe returns if you're a marketplace solution, right? Things like that, which you otherwise wouldn't keep in mind when you're building a financial model, right? And exit options. I mean, like I said, exit is the most important question for a VC firm, and sorry. Huh, is probably the most important question VC firm. But otherwise, I mean, if you're not able to exit an opportunity, then that's, I mean, it's a sunk cost, right? It's a write-off. How lucrative are the exit options? Are other investors investing in the space? Is there an acquisition possible in the coming few years? What kind of strategics would be interested in this, or can this company become large enough to go to an IPO? Questions around that. I think these are things that affect our perception of risk, and hence the valuation that we generally give the company. Right. So getting straight into the valuation, a fundamental thing about valuation. There are two things, and this is a bit of a soul search that both VC firm as well as the founding team should do. There is value and then there's price. Price is what emerges out of your discussion, and value is subjective, right? It's different across different investors. Like I said, for example, simple analogy, right? In a bottle of water, a liter of water, the price is 20 rupees, but the value that you would ascribe to water if you were super thirsty versus if you were super sleepy is different, right? So your situation determines the value that you ascribe, but price is a result that comes out of negotiation, comes out of consideration of situation or circumstances in which you're operating, etc. So that's sort of a very subtle difference that you've got to keep in mind. So that's something that I wanted to sort of submit before we get into the topic of valuation itself. It's super subjective, like I said, and it's the cost of capital as a concept that we talk in finance, right? If I'm able to invest in an opportunity which I perceive as less risky, or where I think I'll be able to generate far further returns. My cost of capital is then that benchmark as compared to my investment in maybe a startup that I'm looking to invest in, right? So what's the cost of capital and what is the opportunity cost of capital is something that varies from one investor to other investors. So fundamentally speaking, it's the risk perception and the expectation of reward, right? It's different, like I said, across stages of investors. Alternatives available, like as I said, I mean, probably there might be an investor who's looking at a very similar offering as you are building in your space, right? Which means the valuation conversation will be very, very intense and very, very different as compared to if you were perhaps the only startup in the space that you're operating in, right? Risks, unknown and known. So what you don't know hits you harder. So perceived risks of probably the questions that people might not even be able to articulate in terms of the future of the company, but what's the perceived level of risk drives the valuation differently as compared to other situation, right? And so the stage of the company, like I said, at which stage the company is, will drive the valuation in a different manner. Involves heavy negotiation. In fact, if one of the ways to, in fact, it's an internal joke, but one of the ways to look at how interested a VC firm is in evaluating a company is to see how heavy the negotiation is, how back and forth the conversation goes, right? And sometimes it's a proxy of how much interest there is. So it involves definitely heavy negotiation, and most of them are non-monetary aspects. It's like, and I'm sure you'll have sessions on term sheet as well, so I won't go into those non-monetary aspects. But there are multiple things in a term sheet which are beyond valuation, which will be part of the entire package of the startup, quote unquote, marrying a VC firm, right? So those things needs to be kept in mind, and those things affect valuation a lot in terms of what the number that you arrive at, right? Generally forward looking, the company might not have a lot to offer at this point, or rather might not have a lot to show at this point in time, but the bet is always forward looking, right? The company will disrupt a particular industry or probably will be great at acquisition down the line. Like I said, not the most important part of the investor's job. Maybe we spend 10, 15, 20% of our time maximum talking about valuation. Sure, there are deals which fall through because valuation didn't match, but but those are deal breakers, which can be they can be workarounds of that. But what I'm saying is not the most, not the top of the mind topic for most of the investors, right? And there's something to remember, and I think this is part of the VC jargon. There's something called pre-money and post-money. Most of you might have come across this, but just to be on the same page, there is an investment amount that you generally decide with VC firm, or VC firm comes and offers saying we're willing to put X amount of money. They do what's called a post-money valuation, which is the investment amount, include the investment amount, what's your company valued at, and they derive the pre-money based on the investment amount itself. So post money minus the investment gives you the pre-money. It's simple thing, right? For example, let's talk about an early stage VC firm which is taking maybe 10% or wants a 10% in your company for $1 million valuation, which means a 10% for $1 million will mean 100% of the pie will be equal to $10 million, right? So that's a post-money valuation, which means the VC firm will hold 10% of the company post-investment of $1 million, right? So pre is when you deduct that investment from the post-money to arrive at a pre-money. So pre-money will then be $9 million, right? So that's how you generally arrive at your pre-money valuation. Dilution is the investment divided by post. Typically, like I said, in my case, it was 1 divided by 10, which is 10%, right? So that's typically, this is sort of an overview of evaluation, some fundamentals, some approaches to equity valuation, and some of these actually might not be relevant to startups, but just to take you through some of the fundamental concepts, and so that you keep this in mind. In fact, there's only one which is sort of relevant to the startups, and probably I'll take you through example, and this is a VC valuation method that is one close to my heart, and I think it's much more relevant than the others for us, for the startups that we look at. There is present value. Of the concept of present value basically is bird in hand, two in bush. So the money today is more valuable than the money tomorrow, which means money loses value as you go. So there's something called discounting that we say. So if you have $1 million now, and then $1 million down the line is what you expect the company will make, you discount it, or you divide it by a discounting factor which is linked to your cost of capital. For example, if my cost of capital, let's theoretically say I have borrowed from, I'm not a VC firm, but I've borrowed some money from a bank, right, to invest in startups, and I have promised my bank a 10% interest, which means my cost of capital is 10%. I will discount all the future cash flows by a factor of 1 plus 0.1. Just 1 plus 10%, it's 1.1, right? If it is 2 years down the line, I have to pay 10% annually, which means I will divide by 1.1 raised to the power of 2. So that will be the discounting factor based on which I will discount all my future cash flows. Some of you might be finance graduates, so you already know this concept. But just to share this with people who have come from a very strong tech background, there's always a discounting involved when there is a future cash flow that we're talking about. So basically, you're when you have streams of cash flows, you discount them based on what point in time they are in before you add them into a single stream of cash flow, right? That's how you arrive at what's called a net present value by discounting it. And there's a cost of capital which varies from one investor to another based on what is the source of capital, who are the LPs, what are the expectations, etc. So some of the well-known methods and traditional methods that have been around is dividend discount model, which is the value of the firm. Basically, you're saying that if there's a company which is giving out dividends to its investors, you discount all the dividends across the time. I mean, for example, you're looking at next 10 years of projection, you're doing a discount of all the you're discounting all the dividends that are going to come in the future and arrive at the present value, right? So that's one way of looking at it. Typically, again, like I said, this is relevant for listed entities which provide, which pay out discount on a quarterly basis or annual basis, depending on the time period. And this is from a very non-controlled perspective, which means you are typically a retail investor investing in a public listed firm where you don't have a say in how much dividend generally gets paid out, right? You just take what you get. Typically, for very mature firms, there's a dividend policy that they follow in. So all you have to do is discount those dividend stream and then arrive at a value, right? It's again not relevant for startups. There's another control perspective method, which is called as cash flow model or discounted cash flow model, DCF. It comes in various forms. And two sort of very well known ones are what's called a free cash flow to firm, or FCFF, and FCFE, which is the free cash flow to equity. Typically arrived at the cash flow. I mean, the some of you who have exposure to the accounting statements know that the profit after tax is a accounting arrangement. I mean, it's arrived at based on accounting non-cash expenses. So what you do is you typically deduct the non-cash expenses, and from your net income, which is the profit after tax, you arrive at the cash flow. You will find many of these templates online as well to arrive at the free cash flow, and you that becomes the dividend equivalent in this case, and you discount that across years. You discount cash flows across the years that you project, and then you bring it to the present value, and then you value the firms. This is again a very private equity method, and generally doesn't apply for startups, because anyway the cash flow will be for the next 4-5 years will be negative, or at least 3 years will be negative, and it doesn't make sense discounting negative cash flows, right? Because as a tech startup, you are focusing on scale rather than cash flows. So this is not something that will be very, very valid for you. Comparable methods, and this is something that has started gaining prominence because now you have data being covered by a lot of well-known publications, like you have the Ken, or probably you have PitchBook, which are the tools used by a lot of venture capital firms, or Traction, or basically databases which cover a lot of these financial details of transactions. So you one have access to the publicly listed companies in that space, where you know the valuation ratios, like you have price to sale, you have what EV by EBITDA, which is enterprise value to the EBITDA of the company, and so on. So you have access to the public details, or you also have access to transactions which have taken place in the same industry. So you calculate similar valuation ratios and compare that with the revenues that you're projecting, and then you value based on that, and then you start discounting, right? That's another method that's gaining prominence. There are multiple other approaches. There's something called market value assets, where when the company is winding down, you calculate the sum of the asset value. For example, the IP, there could be some hardware, some kind of servers that you have installed. I mean, all the typical assets that you have, you find out the market value and start summing them, and then you attach a sort of winding down value to them. Or there's a negotiated value. You take a comparable or maybe a alternative asset in the same space, and then you start negotiating based on that. The multiple other methods, there's something called as risk scorecard method, or what's called Berkus method, where there are multiple fundamental factors, like how risky the betting on the founding team is, versus how risky is the space, what's the probability of an exit. I mean, you list down your multiple factors, and you provide a premium or a discount to a comparable valuation number you have from the space, and then you build on a valuation number. I mean, find many such quote unquote commonsensical methods on online, and multiple investors look at it multiple ways. But one thing that, like I said, is something that I find very relevant for companies at an early stage is what's called a VC valuation method. And probably I will go through a template. I will just probably go through a sample of that. Probably I'll go through a financial modeling sample before I get to that. And let me quickly open the model that I had. Some circular error here, but 1 second. I'll just close this. Yeah. So this is just to give a background. Back in before I joined Chiratae Ventures, I used to work with Bharat Innovation Fund, and there we had evaluated an opportunity in the digital pathology space. Again, not sharing the names for confidentiality purposes, but also we didn't invest in the company. We didn't end up investing in that company for various reasons. But I think the experience was very enriching because we learned a lot as an investment team. Right. So one of the internal models that we had made for that is this, and we looked at maybe Just taking you through some of the assumptions that they had built. The reason I'm taking the financial model is this will feed into the valuation method that I'm going to talk about. We made certain assumptions on the deployment of the scanners that the company was developing. We looked at the cumulative based on year by year. We estimated the total installations across years. We had assumptions on price, and these are things that are very important, right? One of the when I speak to entrepreneurs, one of the things that I tell them is have a financial model ready. Don't focus too much on the numbers, but focus on the assumptions. What we see very, very closely is how well is the founding team able to think through their growth, and how crisp are the assumptions, and how are they able to back these assumptions based on the data available, based on their experience, based on customer conversations, etc. Right? So your assumptions into a financial model are super, super important. The number is secondary; it just comes by. But if you're able to think through a space well and build a model which gives confidence to the VC investor, then probably you have hit the result that you would want from a financial model. So we made certain assumptions on the price, cost of goods sold, took up a certain percentage, and we had assumption on year. There were some other AMC costs that was there, and this on the cost itself there are multiple assumptions on how the manpower will flow, or how the staffing will increase year on year, what is the cost, other expenses, and there's some reference error here, but the other variable and fixed expenses, right? So this is the typical exercise that I would encourage you as founders to think through as well when you're building a financial model. And these assumptions then flow into, then it's just linking, right? You're presenting it in terms of your profit and loss statement. What's the revenue? How is the revenue growing across markets, across your, this company had multiple models of scanners. So what is the sort of what is the breakup across the offerings and product types, use cases, geographies, the various expenses, both fixed as well as semi-fixed and variable, and how the company would grow in the next 4 or 5 years based on the founding team's assessment, right? Of course, balance sheet and cash flow are secondary. Even if you can put together a sound P&L statement, I think should be fine for the first conversation. Balance sheet and cash flow anyway, again, will grow through based on your other assumptions, on your working capital, on your fixed assets, on your multiple other assets in terms of IP building, etc. Cash flow generally comes out as a result of P&L and balance sheet, right? IR analysis is anyway for us. So the point I'm trying to make is have a very strong set of assumptions based on which you would build your financial model. Just coming back to the slides that we used. Like I said, revenue projections. Think through every single so-called non-obvious things. For example, what's the customer churn across years, right? How will you maintain, or how will you retain the customers? What's the top-up revenue from the same set of customer base? How can you generate more revenues? How can you cross-sell? How can you go next year and provide a better feature for which you'll be able to charge them higher? Right? Think through all those things very, very carefully. Have a very, very strong hold on your cost structure. And this is a very, very easy way of understanding how clear the founding team is. Ask them what's the variable cost, how is it varying, what's the gross margin year on year, and how what's the kind of economies of scale that they see. Decrease in the cost percentage across years. What's the fixed cost? How can they reduce it? This is the space where I think a lot of entrepreneurs fumble, and I think spending some time on this is super, super important before you present your financial models to investor. Right? This is where the clarity should emerge. Another thing is which I think founders ignore a lot is what's your investment requirement year on year, right? It could be debt, it could be equity. A lot of founders, in fact, go for venture debt once they secure some amount of equity investment. So how are you thinking through that? How are you allotting your ESOP, right? That's another sort of point which founders ignore a lot. Providing compensation to your founding members or senior members through ways other than cash, right? Making them part of your growth stage, I think, is very, very, very important. So thinking through that and how it impacts your cap table is super, super important. That has impact on your ability to take investments in the future as well. So yeah, I think these key inputs it's very, very important for you to be very, very clear about, right? Some of the key metrics that VC will definitely ask you on: what's the customer acquisition cost, what's the sales cycle, how long is the sales cycle from the pitch time to the conversion, how much time does it take, the multiple metrics for multiple industries, like the ARR, MRR for SaaS, there is LTV, CAC, for both SaaS as well as B2C in technology. There is what's called a cohort analysis that a lot of B2C investments team make for both the portfolio as well as potential investee companies. They look at customer churn, how we're able to retain customers, and what's the cohort's revenue month on month, quarter on quarter. Some of these things are, I think, very, very important for you to keep in mind. Again, I'm not going to details of these because these are it's not core to valuation, but these are very important when you're talking through your financial model. Lifetime value of customer, understand what's the profit coming out of your engagement, how is the pricing change, what's second order impact. I mean, some of the choices you make on price will start affecting your place among the competitors in the industry, right? There might be a larger competition who might undercut you on price, so there is a limitation of how much price that you can charge. So these things, I think, are super important. What's the cost structure, like I touched upon the previous slide, and what on your break-even analysis, how many items that you need to sell, or how many customers you need to onboard, what are the different markets, and what are the, if you're going after subscription revenue, what is the kind of customer base that you need to have to operationally break even, right? Where you're able to cover your cost using your revenue, right? Repeatable revenue, right? Where let's say the mouths you feed have enough food on the table. That's the kind of break-even analysis, both at operational level as well as financial. Financial, I think, can take a back step, but at least on the operational level, how quickly can you break even? What's the level of effort that you need to put as a team to get to, and what's the kind of return on investment? Exit projections are usually done by the investment team and not you, but generally there might be inputs from the investment team that they would require from you before they get into a valuation discussion. Before I come to this, probably I'll take you through another template which I made on a VC valuation method. I'm just conscious of the time too, but anyway, let's go through this, right? Typically, and this is also a model that we built when we were evaluating that digital pathology company I spoke to you about. This is and the reason why a lot of us prefer VC valuation method is it takes care of dilution across rounds, right? And this is very, very, very important. I think this is something that as founding teams you should appreciate, and as investment teams, I think we should appreciate as well. When you come in a particular investment round and you invest a particular amount of money, and you're preparing the team for the next round, and there's a larger investment round required, the dilution that you go through is going to be significant, depending on how large that round is. And you need to account for that when you're modeling your exit. For example, you as a founding team is presenting a probable exit model to the VC investment team. You have to keep dilution in mind and probably give it a lot of importance before you put out a number in terms of valuation. And this is what we tried to model in this template also. So just to take you, I won't go into details of this sort of a full-fledged model, but just to give you some numbers on how we arrived at some of the numbers. We took a comparable. There were two companies which we found. One was acquired by Strategic, and one company went to IPO, and we found what's a price to sales model, a valuation ratio. We took an average of that. We used that average to along with the projections. The company had projected that the company will get to maybe $25 million at the end of 5 years. We, of course, used three different cases. One case where the company would reach to 60% of what's projected. One is 80%, and one's 100%, right? So bad, medium, and best sort of case, right? So for each of those cases, let me take you to the first case itself, where we assume that the company will hit 60% of what it's projected, which means it will hit $15 million at the end of 5 years. Used a valuation ratio, arrived at what the valuation will be at the end of 5 years, right? There is a discount ratio, sort of discount number that we had used, so it's 50%. It's large here because, again, it's an emerging market, so the risk that we perceive is typically higher. So we discounted cash flow on a 50% IRR year on year, right? So we arrived at a number at the end of 5 years. We discounted it to end of or beginning of 3 years. So basically 3 years of discount that gave us a post money at the end of Series B, which we assumed will happen in the beginning of the year. We arrived at the post money there, and assuming that the company grew after taking that investment, right? So we arrived at the post money there by discounting this by 50% for 3 years. And from there, we had assumed that the round required in Series B is $12 million. We deduct that investment amount to arrive at a pre-money post Series B in the beginning of year 3, right? So year 5 discounted by 3 years, arrive at a post-money valuation, deduct the investment, arrive at a pre-money valuation, right? So, and we assume that year 1, at the beginning of year 1 is where we're investing a Series A, which means this needs to be discounted back to beginning of year 1. So 2 years of discounting is what we need to do. And using 50% as the discount rate, again, we arrive at a post money of 1 year, assuming that the company would take the investment and then grow. So we arrive at a post money. This is the one. We arrive at a post money of $17 million. From there, we had assumed that the current round will be $5 million. So you deduct that to arrive at what's called a pre-money valuation, right? I'll again go through this process. So arrive at a terminal revenue, discounted by 3 years, arrive at the post money of Series B, deduct the investment amount, arrive at a pre-money here, discount it again, arrive at a post money post Series A, deduct the investment amount, arrive at the pre-money valuation, right? And of course, there's multiple other things that you need to do in terms of calculate share price, etc. I'm not going into all that. That's typically the investment team activity, but this is how a typical valuation happens on a VC valuation method. Like I said, it takes care of the dilution that's happening here, especially when the company is when the VC firm is looking at investing certain amount at various rounds. They need to take care of this part, which is on how much are they diluting, right? For example, in the first round itself, if the pre-money is around $12.5 million, which means the post-money is 17, the total dilution is around 28.69%. But fast forward, when the company grows, it would need much more capital, it's around $12 million, but dilution there is 30%. So they need to keep their follow-on capital ready to ensure that they can maintain their shareholding as they move forward. And this is very, very important because even as founders, you would dilute. You would dilute, say, in this case, around 36% and come to 64%. Probably you go to 40 to 44% and so on. But it's very, very important for you to keep in mind the amount of dilution that takes place at various stages. Probably you'll raise one more round before you get to exit. Here it is just 2 rounds, which means you dilute more. So you need to use that as an input for decisions like how much to raise, how much ESOP to offer your potential employees or employees right now and potential employees in the future as well. So those things come into action based on dilution levels, and that's one of the advantages of a method like this, and which is why I think this is something that's very close to my heart, and I urge almost every founder that we come across to look at this method very, very closely. So just to sort of take you to the conclusion, we did three cases here based on the scenario analysis, and we put different weightages to each of those cases. We arrived at a weighted pre-money valuation and share price, which we calculate based on the number of shares, right? So that's how we arrived at the number. We use you use this number to build a cap table as well. So before Series A, it was just the founders, and there was an ESOP pool of 10%. We used that valuation number, which came from a different sheet on this. We'll use the share price as well to arrive at the shareholding that the 2 VCs would have, and also arrived at a possible shareholding depending on what the Series B round looked like, right? And that's again coming from the weighted average there. So so that's how generally this is built. So financial projection feeding into the VC valuation model, which feeds into the cap table. So the 3 different levels at which you arrive based on how much capital you need to raise and what's the kind of dilution that you're looking at, right? So let me come back to the sheet that we were talking about. Yeah. So that's broadly what I wanted to cover on the cap table and on the VC valuation method itself.